Welcome to the Poseidon Finance channel. Do me a favor and hit the like and subscribe button. Let's get started. So one of you forwarded me an article last week. I think it was Maya. Maya, was that you? Okay. The headline was something to the effect of BlackRock is buying every house in America. The article had been making the rounds. People you know are angry about it. Your parents are angry about it. There have been speeches in Congress about it. And I want to use that headline as the door we walk through today, because almost every part of that framing is wrong. Or, let me be more careful. It is not exactly wrong. It is misnamed. And misnaming the thing makes the thing impossible to fight, because you are swinging at a phantom while the actual structure does its work in another room. Here's the first thing. BlackRock, the company, does not own a meaningful number of single-family houses in the United States. They are an asset manager. They run roughly $10 trillion of other people's money. Their direct holdings of detached suburban houses are, in the scheme of things, trivial. The firm that does what people accuse BlackRock of doing is mostly Blackstone. Different company, different ticker, same general neighborhood of Manhattan, which is part of why the names get scrambled. And then there are 4 or 5 others. Predium Partners, which runs Progress Residential, American Homes 4, Rent, Tricon, before Blackstone bought them in 2024, Invitation Homes, which is itself a Blackstone child grown up and gone public. That is the cast. Maybe 7 names total, depending on how you count. Not BlackRock. I cannot say that often enough, because every time someone yells at the wrong company, the right company gets a quiet day. Let me show you what this looks like at the ground level. Henry County, Georgia, 30 miles southeast of Atlanta, Stockbridge, McDonough, Hampton, the whole stretch. The data in some of those zip codes, and I want to be careful with the year, because the most reliable cut I have seen is from a Georgia State working paper that I think came out in 2022, possibly 2023. The institutional ownership rate of single-family rentals in some of those zip codes is north of 25%. 25%. Let that breathe for a second. 1 in 4 of the houses on the rental market is owned by a firm with at least 1,000 homes under management. And when you cut it finer, when you look at houses built between, say, 1995 and 2010, 3 bedrooms, in well-rated school zones, in subdivisions without rental restrictions, you are looking at a slice where institutional concentration crosses 50%. 50. Let me say it again, because the number does not sound right. In specific operational segments, in specific zip codes outside Atlanta, more than half of the rentable single-family inventory is owned by a handful of firms. Now, people who want to defend the industry will say, and they have said in op-eds, on podcasts, in comments to journalists, that the national institutional share of single-family rentals is only around 3 to 5%. And they are correct. Technically, they are correct in the way that telling someone your foot is in the freezer and your head is in the oven, and on average your body temperature is fine, is correct. The average is meaningless. The distribution is the entire story. And the distribution was chosen. It was not random. Where did this start? Quickly, because we have a whole section on the history. 2012, the aftermath of the 2008 collapse. Hundreds of thousands of foreclosed homes sitting on the books at Fannie Mae and Freddie Mac, dragging down the housing market. Blackstone, and other firms, but Blackstone first and biggest, built a vehicle. They started buying. By 2014, they had something like 40,000 houses. By 2017, when Invitation Homes went public, they had 80,000. The first rental income securitization, where you bundle the rents from a few thousand houses and sell them as bonds, happened in 2013. Around $480 million. Maybe a few million off, but in that neighborhood. That deal, that single deal, is the moment this stopped being a real estate strategy and started being a capital markets product. Once the bonds work, the strategy is no longer constrained by how much equity you have. It is constrained by how much demand there is for the bonds. And demand for the bonds, in a low-yield environment, was effectively infinite. I have a former student. I'm not going to name her. I'm not even going to tell you which firm. She runs part of an acquisitions team at one of the names I just listed. We get coffee maybe twice a year. The conversations I have had with her over the last 4 years are honestly more of the curriculum for this lecture than anything I have read in the trade press. The trade press gets the perimeter of the story. The academic literature gets the data, but is usually 2 years behind. The thing she tells me, and I will bring it up again later, is that the model has become so industrialized that the question is no longer, should we buy this house? The question is, has the algorithm flagged it, and does our local operator have capacity to onboard it within 30 days? That is a different industry than the corner landlord. Not bigger, different. The scholar I want you to know about, by name, is Desiree Fields at Berkeley. She is a geographer. She has done some of the best academic work on the financialization of single-family housing, and she uses the term financialization in a specific way that you should look up, because the textbook definition is not quite the right shape for what she is describing. Read her. The papers are dense, but they are dense in the way that good academic work is dense. There is something underneath every paragraph. One last thing before we go in. I want you to hold a question in your head the entire time. Not the question of whether this is good or bad. That is a separate conversation. The question is, why is this happening now and not in 1987 or 1994 or any of the previous moments when capital was looking for yield? What changed? Because nothing about owning a house and renting it out is new. The corner landlord is older than the country. What is new is the scale. What is new is the operational technology that lets you run 40,000 houses across 19 markets from one building in Dallas. What is new is the financing. And what is new is, and this is the one I want you to feel by the end, what is new is that the federal government, in ways that are almost entirely invisible to voters, made this profitable on purpose. Or made it profitable while looking the other way. Same outcome. That is where we start. So the first thing you will hear, every single time this gets discussed in a serious forum, and by serious I mean an industry conference, a Federal Reserve research paper, a Brookings report, is that institutional investors own only about 3 to 5% of single-family rentals nationally. The number gets repeated by industry trade groups. It gets repeated by reporters who are trying to be careful. It gets repeated by economists who want to push back on what they see as populist hysteria. And the number is right. I said it last section. I am not taking it back. But the number is being used to make a point that the number cannot support. The point is, this is not a big deal. The point is, therefore the rest of the conversation is overheated. And both of those conclusions are wrong, and the reason they are wrong is that you cannot understand a concentrated market by looking at its national average. Here is the analogy I want you to hold. When Walmart was destroying small-town retail in the 1990s, and I lived through that as a kid in a small town, my parents owned a hardware store that did not survive. When that was happening, you could have looked at Walmart's share of total retail and said, this is a small percentage, retail is a vast industry, this is a non-story. And you would have been wrong because national share was not the right measure. The right measure was, what percentage of retail in towns under 20,000 people is now Walmart? And the answer to that question, in a lot of those towns, was somewhere between 60 and 80% of the relevant categories within 5 years of the supercenter opening. The national number missed the entire structural change because the structural change was geographic and segment-specific, not national and broad. That is exactly what is happening with single-family rentals. The institutional firms did not buy a random 3% of American houses. They bought a very specific 3%. They bought what is called the entry-level rental home. 3 bedrooms, 2 bathrooms, built between roughly 1990 and 2010, between 1,500 and 2,200 square feet, in well-rated school districts, in metros with population growth in the top quartile of the country. That is the buy box. Every firm has its own version of the buy box. The boxes overlap by something like 75%. So when they're all shopping in the same operational segment, which they are, you get a level of concentration that no national average will reveal. Let me give you a case. Cobb County, Georgia, northwest of Atlanta. There is a teacher I read about, and I want to be honest, this was a profile in The Atlantic, I think 2022 or 2023. The journalist was Francesca Mari, and her work on this is some of the best. There is a teacher trying to buy her first house, dual income with her husband, both public sector workers. They put in offers on something like 14 homes over a year. They lost every one, most to all-cash offers. The all-cash offers are the tell, because regular buyers, even wealthy ones, almost never bring all cash to a $400,000 house. Only 2 kinds of buyers do. Ultra-wealthy individuals who do not bother with $400,000 starter homes in suburban Atlanta, and institutions. So when 14 houses in a row go to all-cash buyers, you do not have a real estate market. You have an extraction process with a real estate market wrapper. Now, I want to push back on myself here because you should always be suspicious of arguments that are too clean. There is a competing view I take seriously. The competing view says, look, institutional buyers are providing rental supply that the market needed. They are improving the housing stock. They are adding professionalization to a market dominated by mom-and-pop landlords who, if we are being honest, run buildings worse than the institutions do. And in some specific senses, those claims are not wrong. Institutional landlords do, on average, maintain properties to a higher standard than the median small landlord. There is research that suggests that. The professionalization argument has real merit. I want you to be able to argue both sides of this in a job interview. I would rather you wrestle with it now than be unprepared. But, and here's where I come back, the professionalization argument is being made about a market structure that the firms themselves engineered. They did not show up to fix a broken market. They showed up to a market that was made fixable, briefly, by the worst housing collapse in American history. And the entry point they used at scale, in 2012, was a federal program I'm going to walk through next section. The professionalization argument is downstream of a federal policy choice that handed inventory to a small set of buyers at a scale that no individual buyer could ever match. A digression, because I think it matters. There is a particular thing that happens in academic finance where you can find a defensible argument for almost any market structure if you frame it narrowly enough. Efficient markets, risk premia, liquidity provision. The argument that institutional landlords are providing a service is a version of that move. It is true at one level of abstraction, and it stops being true the moment you ask, at what scale, at what concentration, with what externalities, on whose backs? I had a paper rejected once, and this was years ago, I'm not bitter, mostly, for asking exactly that question about a different market. The reviewer comment said the analysis was too political, which is itself a political statement. Anyway, back to the point. The point is, the 3% number is an average over a distribution that has been deliberately shaped. The shape matters more than the average. The shape is what we are going to look at next. The historian Michael Lewis once wrote about a different industry that the most important question to ask is who designed the system you are looking at. Lewis is not an academic, he is a journalist, but his instinct is right. Systems do not arise from nowhere. They get built by people with names in offices that you can find on a map. The system that put institutional landlords in your neighborhood was built by people. Some of them are still alive. Some of them are still in the same offices. We are going to walk into one of those offices in our minds in a few minutes. Okay, the history. The version of this story you have heard, if you have heard any version, is that after the 2008 financial crisis, hedge funds and private equity firms swooped in opportunistically and bought up a bunch of foreclosed homes. That story is true. It is also, in a way I want to make precise, deeply incomplete. Because what gets left out is the role of the federal government, not as a passive observer of the swooping, as an active enabler with a specific program run through Fannie Mae and Freddie Mac that handed the door key to a small set of buyers. Let me set the scene. 2008, 2009, the housing market collapses. Foreclosures spike. The government takes over Fannie Mae and Freddie Mac and puts them in conservatorship. By 2011, Fannie and Freddie collectively own something on the order of 250,000 foreclosed properties. These are properties the lender ended up holding because the borrower defaulted. And these portfolios are dragging down the housing market. The thinking inside the Treasury, inside the Federal Reserve, inside the regulators, and this is the part I want you to hear, was that the houses had to clear. The market would not heal until those foreclosed homes were absorbed into stable ownership. Stable ownership. Hold that phrase. Now, in February of 2012, Fannie Mae announced what came to be called the Bulk Foreclosed Home Pilot. The structure was Fannie packaged hundreds of foreclosed houses into bulk pools, divided geographically. Atlanta, Phoenix, Las Vegas, Florida markets, California markets. They invited bids. The catch was that to bid, you had to qualify as an institutional buyer with a certain operational capacity to manage rentals at scale. And the homes had to be rented, not flipped, for a minimum holding period. The first pool, about 2,500 homes, sold in mid-2012. The buyers were a small handful of firms, Blackstone, a Pacific Investment Management Company subsidiary, Colony Capital, and a couple of others. The price was, by most accounts, well below the prevailing market. Stop and look at what just happened. The federal government took 2,500 houses, restricted the bidding pool to firms that already had the capital and operational scale to manage rentals at the scale the program required, sold the houses at a discount to those firms. That is not a swoop, that is a handoff. There is a real argument, and again, I want to give you the steel man, that handing off was the right call. The houses needed to clear, the market needed stability, individual buyers could not absorb that volume, mom and pop investors did not have the operational chassis. Institutional buyers did, so you got the houses cleared and the market stabilized. That is the policy defense. I take it seriously. I just want you to notice what was actually being done. Now layer the Federal Reserve on top. 2008 to 2015, short-term interest rates pinned to zero, 3 rounds of quantitative easing pushing trillions of dollars into the financial system in search of yield. If you are running a pension fund and you have to hit a 7.5% return target to meet your obligations to retired teachers, and Treasury bonds are paying 2%, you have to find yield somewhere. And what you find, eventually, is that a portfolio of single-family rentals in Atlanta, with rental yields of 7, 8, 9% net of expenses, is one of the few asset classes that meets the target. So institutional capital floods in, not because of a conspiracy, because of a yield problem the Federal Reserve created. The cross-domain analogy I want you to hold here, and it is an uncomfortable one, is what happened in post-Soviet Russia in the 1990s. I am not equating the two. I want to be careful. Post-Soviet privatization was orders of magnitude more brazen and more corrupt. But the structural move is similar. The state holds a large pool of distressed assets. The state lacks the operational capacity to manage those assets directly. So the state hands them off, through auctions, through pilots, through programs, to a small set of well-positioned buyers who then have a multi-decade head start on everyone else. 20 years later, you ask, Why does the same group of people own everything? And the answer is buried in a 1995 transfer document nobody reads anymore. Same shape. Different scale, different morality, same shape. I want to tell you about a moment. In February of 2012, around the time of the Fannie pilot, actually it might have been a few weeks before, Warren Buffett went on television and said, more or less, that if there was a way for him to manage them, he would buy a couple 100,000 single-family homes. He said the math worked. He said it was, in his view, one of the best asset classes available. The clip is on the internet. It is worth watching. Within the industry, that interview is a folk memory. People remember where they were when they saw it. I was in a hotel in Chicago, I think for the American Finance Association meetings, and a colleague forwarded it to me with no message, just the link. Buffett does not say things lightly. When he says the math works on a couple 100,000 homes, the people who run capital pools hear a starting gun. The first single-family rental securitization closed in 2013. Invitation Homes was the issuer, around $480 million. The bonds were rated investment grade by the major rating agencies. That deal, I cannot say this strongly enough, that deal converted single-family housing from a fragmented, illiquid asset class into a liquid capital markets product. The moment the bonds work, the strategy scales without limit because you are no longer constrained by equity capital. And 4 years later, Fannie Mae itself, the same entity that started this with the pilot, provided a roughly $1 billion loan to Invitation Homes to support its rental portfolio. The federal mortgage system extended a loan to support a single-family rental portfolio at scale. Read that twice. The pilot was eventually wound down under public pressure. The relationships were not. A digression, briefly. The economist Atif Mian, with Amir Sufi, has written extensively about how the post-crisis recovery distributed itself. Their argument, simplified to a sentence, the recovery flowed disproportionately to creditors and asset owners and not to debtors and workers. That is not a controversial finding among researchers who have looked at the data carefully. What gets less attention is that the policy choices that produced that distribution were made by people who knew what they were doing. They knew. The bulk foreclosed home pilot did not happen by accident. The interest rate policy did not happen by accident. The agency loans to institutional rental did not happen by accident. They happened because the alternative, letting the houses clear through individual sales, raising rates earlier, refusing to extend agency credit to institutional rental, was politically and economically uncomfortable. Easier path got chosen. The country has been living with the consequences ever since. Okay, that is the history. Now we get into how the actual machine works. Here is how it actually works, and I am going to walk you through this in the order it happens, from the moment a house gets listed to the moment a tenant signs a lease. Because once you see the operational machine, you cannot unsee it. A house gets listed in, say, Riverdale, Georgia on a Tuesday morning. Within seconds, and I mean seconds because the data feeds are direct from the listing services, the listing hits the acquisition system at every major institutional buyer that runs in that metro. The system pulls in the listing, runs it through an automated valuation model that compares it to recent sales of similar houses, factors in the school district rating, the crime data, the proximity to major employment centers, the rent comparables, the current cap rate target for that submarket, the renovation cost estimate based on the listing photos, the projected maintenance cost based on the year of construction. All of this happens in seconds. The system spits out a maximum bid price. If the listing is below that maximum bid, the system can be configured to auto-offer at list price with all cash, with a short due diligence period, with a fast close. The seller's agent gets the offer within minutes, sometimes within minutes of the listing going live. Compare that to a normal buyer. A normal buyer sees the listing maybe that evening. They drive by on Saturday. They get pre-approved on Monday. They make an offer Tuesday, contingent on inspection, contingent on financing with a 30-day close. By that point, the institutional offer has already been accepted. The house is gone. This is not the institutional buyer winning a fair fight. This is the institutional buyer fighting a different fight entirely, with different rules on a different timescale. The closest analogy I have is high-frequency trading versus retail equity investors. The retail investor still thinks they are trading the same market as the algorithms. They are not. They are trading the residual after the algorithms have taken what they want. Same situation, different asset class. Once the house is acquired, and we will come back to the financing in the next section, but for now, assume the house is paid for. The operational layer takes over. And this is where the real industrial achievement is. Each major institutional landlord runs what they call field operations through a network of local maintenance teams, contractors, leasing agents, and property managers. The work is centrally underwritten and locally executed. The renovation playbook is standardized. Same paint color, same flooring, same appliance package, same landscaping standards, same signage on the front door. You can drive through a neighborhood in Charlotte and pick out the institutional rentals from a block away because they all look the same. They do not look bad. They just look like the same house was rendered 70 times in slightly different lots. I want to give credit where credit is due because intellectual honesty matters. The operations work is genuinely impressive. managing 80,000 houses across 19 markets, keeping vacancy under 5%, processing maintenance requests through a centralized application, handling lease renewals at scale. That is an operational achievement that the corner landlord could never replicate. There are mom-and-pop landlords, plenty of them, who run their handful of houses worse than the institutional firms run their tens of thousands. The professionalization argument I mentioned earlier has a real foundation. I just want to be clear about what is being professionalized and at what scale and at the cost of what alternative arrangement. My former student, the one I mentioned in the first section, I asked her once what the most surprising thing was about her job. She said it was the meetings. She said when she pictured private equity from the outside, before she got the job, she pictured cigars and shouting and dramatic decisions. What she actually does is sit in 12 hours of meetings a day where the conversation is about whether to onboard 1,400 properties from a Phoenix portfolio acquisition or whether to wait 60 days for the better Tampa pipeline. The conversation is about throughput, about operations, about whether the local field team has the bandwidth. The most striking thing she said to me, and I will paraphrase rather than try to reconstruct her words exactly, was that the actual buying is the boring part. The interesting part is what happens after. The operations, the pricing, the renewal cycles. That is where the money compounds. The pricing. I want to spend a minute on the pricing because this is where the algorithm shows its other face. There is a software platform, and there are 2 or 3 vendors. I'm not going to name them because there is pending litigation in some jurisdictions. Look it up. There is a software platform widely used by institutional landlords that takes data from across all the participating properties in a market and recommends rents. The recommendation engine uses the data from competitors' properties. So if all the major landlords in a metro are using the same recommendation engine, fed by overlapping data, the engine becomes a kind of price coordination tool. There are antitrust theories floating around this. The Department of Justice has filed a statement of interest in at least one case. I'm not going to predict where that lands legally. What I will tell you is that the existence of the tool and the way it operates is exactly the kind of thing where the gap between intent and effect becomes legally and economically interesting. You do not need a smoke-filled room. You need an algorithm, a digression, because I think it is worth a few minutes. There is a related set of technology platforms now being built for commercial real estate, multifamily apartment buildings, industrial warehouses, even neighborhood retail centers, that are basically the same operational machine I just described applied to other asset classes. The single-family rental industry was the proof of concept. The technology is now being exported. In 10 years, you may be living in an apartment building owned by a similar machine, eating at restaurants and retail centers owned by a similar machine, working in a warehouse owned by a similar machine. The single-family example is not the end state. It is the model. The economist Tyler Cowen has written, somewhat skeptically, about what he calls the great consolidation across American industries. His framing is different from mine. He sees efficiency where I see concentration. We are looking at the same data. We are drawing different conclusions. That is what intellectual disagreement actually looks like. And you should get used to it because most of finance is people staring at the same numbers and arriving at incompatible interpretations. Okay, so that is the surface mechanism. Algorithms acquire. Local teams operate. Software prices. Capital flows. That is the visible layer. Next section we go underneath. Now we go down a layer because the operations and the algorithms and the field teams, that is the surface. That is what the trade press writes about. That is what the documentary crews film. The actual structural achievement, the load-bearing wall of the entire industry, is the financing. And the financing is doing something that is not, to my knowledge, well understood outside of capital markets. Here is the basic move. You buy a few thousand houses, you rent them out, you collect rent. The rent is income. So far, this is the corner landlord just at scale. The next step is what changes everything. You take that rental income, a stream of cash flows from a few thousand tenants in a few markets, and you bundle it. You put it into a special purpose vehicle. You issue bonds against that vehicle. The bonds pay coupons funded by the rent collections. Senior bonds get paid first. Junior bonds get paid second. The riskiest bonds get paid last and earn the highest yield. Bond buyers, pension funds, insurance companies, sovereign wealth funds, buy these bonds because they are rated investment grade and they pay better than corporate bonds of similar credit quality. The institutional landlord uses the proceeds from the bond issuance either to pay back the equity used to buy the houses or to buy more houses. Capital recycles. Equity returns improve. The strategy scales. This is not new technology. This is what was done with mortgages starting in the 1970s, with profound consequences, some good, some catastrophic. This is what was done with auto loans, credit card receivables, student loans, commercial real estate. What is new is applying it to single-family rental income. The first deal, I mentioned it earlier, closed in 2013, Invitation Homes, around $480 million. The market for single-family rental securitizations is now well into the tens of billions of dollars in cumulative issuance. There are dedicated bond investors who specialize in this asset class. There are research analysts at every major investment bank covering it. There is, in other words, a fully formed capital markets product around the cash flows of houses in Henry County, Georgia, that 30 years ago nobody on Wall Street thought about. Layer 2 of the hidden wiring, the agencies. Fannie Mae and Freddie Mac, which were created to support owner-occupied housing, that was the founding mandate, owner-occupied, have been quietly active in the single-family rental space. The 2017 loan to Invitation Homes I mentioned earlier was framed as a pilot. The pilot was discontinued under public pressure, but their relationships did not disappear. The agencies still purchase loans on small landlord rental portfolios. They still provide some forms of credit support to the broader rental market. The idea that the federal mortgage system is purely about helping families buy homes is, at this point, a story we tell ourselves. The mortgage system has slowly become bidirectional. It supports owner occupancy. It also, indirectly and sometimes directly, supports institutional rental. The two activities use the same infrastructure. The capital flows the same direction. And every dollar the federal credit support extends to institutional rental is a dollar of subsidy that does not flow to the family trying to buy that same house. Now the third move, and this is the one that came on more recently, build to rent. Around 2019, 2020, and the trend accelerated through the pandemic, institutional firms stopped trying to outbid families for existing houses in some markets and started building entire subdivisions designed from the ground up to be rentals. Single-family detached homes, cul-de-sacs, garages, backyards, the whole simulacrum of the suburban dream. Built by a home builder under contract, never listed for sale, transferred directly to the institutional owner, leased to families. There are now build-to-rent subdivisions in Metro Phoenix, where the closest comparable owner-occupied subdivision, 3 streets over, is built by the same builder with the same floor plan. The only difference is which contract the builder signed. Same house, same street, same neighborhood. One contract makes you a future owner. The other contract makes you a permanent tenant. A digression I want to make, and I will keep it brief. The build-to-rent move tells you something about the long-run intent of this industry. If the firms believed the cycle was about to end, if they thought rates were going to stay high, that home values were going to fall, that institutional rental was a temporary opportunistic play, they would not be signing 20-year contracts with national home builders to construct subdivisions from scratch. The build-to-rent commitments are the industry telling you with their checkbooks that they intend to be in this business indefinitely. This is permanent capital deployment. The polite term for what happens after permanent capital deploys at scale is that the asset class becomes institutional. Once an asset class becomes institutional, it does not de-institutionalize. Mall investment trusts did not unwind. Industrial logistics trusts did not unwind. Self-storage did not unwind. There is no historical example of a major real estate asset class becoming institutional and then reverting. None. It does not happen. Let me give you the historical analogy I have been holding back. The transcontinental railroads in the 1870s and 1880s were granted enormous tracts of federal land along their rights of way. The grants were rationalized as necessary to incentivize building the railroads, which was a public good. The grants were also, by any honest accounting, a transfer of public wealth to a small number of private owners, on terms that no future Congress would be able to undo, with consequences that shaped American land ownership for the next century. The historian Richard White has written about this in a book I recommend, Railroaded, and his argument is that the rationalization at the time obscured what was actually happening. We are now, with single-family rentals, in the rationalization phase. The story being told is that institutional landlords are professionalizing a fragmented market. The story being lived, in specific zip codes around Atlanta and Phoenix and Charlotte, is a transfer of intergenerational wealth. The two stories are both true. The second one matters more. I want to leave you with one closing thought because we have covered a lot. The reason this is happening now and not in 1987, the question I asked at the beginning, has 3 answers. 1, the 2008 crisis created the inventory and the federal program created the entry point. 2, the Federal Reserve's post-crisis interest rate policy made yield chasing into housing rationale at a scale never before possible. 3, securitization technology, plus operational technology, made it possible to manage and finance houses at a scale that was previously impossible. Take any one of those away. Really, anyone. And this industry as currently configured does not exist. Put all 3 together and you get an outcome that almost looks designed. It was not designed, or, let me hedge, no single person designed it. But the system that produced it is the system, and the system, as it stands, has no off switch. Be careful with where you live. Watch the firms that own your neighborhood. Pay attention to what gets built and who builds it. The world your children will live in is being underwritten right now in conference rooms in Manhattan and Stanford and Chicago. That is the lecture. We will pick up next week with the legal and antitrust angles, which is its own conversation.